All right. If everybody could please mute their microphones, that'd be very helpful. And we'll get this started. My name is Rege. This is Anchorage Meetup Summer Session 128. I'll be going through this today. Thank you to all of you for joining in, and let's get started. First things first, a disclaimer. All comments made and materials presented during this IBD meetup are for educational purposes only. They are not intended to be interpreted as investment advice or buy, hold, and sell recommendations. All investments have risk. Past performance is no indication of future performance. The possibility of losing money is a risk each investor might be willing to accept without looking to blame anyone at IBD or the meetup organization, or in particular, Floyd, Mr. Rege, or unpaid volunteers. Personal responsibility of each individual investor is the key point in this disclaimer. And if you accept the provisions, you can continue to participate in tonight's meetup. Thank you to Floyd Dameron for letting me take over in the summer, for Rick Kelleher, who helped Floyd put everything into Excel, for Gary Taylor, who then took all that information and the mechanics behind it, put it in TradingView, and Miss Amy Smith for allowing me to present under the IBD umbrella. So today's agenda, we're going to start with the IBD Market Pulse. We're going to look at LETF year-to-date performance, SOXL weekly stochastic with and without a Weinstein style of indicator. I'm going to go through a detailed backtest, year-over-year returns, drawdowns, portfolio performance. Then we're going to take a look at some new inputs for both the weekly and the daily. And go through those new inputs in a detailed backtest as well. Then we're going to look at the difference between drawdowns versus losses to understand what the differences are, and compare drawdowns versus losses for these new inputs we just tested. The last thing we're going to cover is dollar cost averaging, comparing dollar cost averaging to the SOXL weekly, and some of the shortcomings and pitfalls and what to look out for. And then we'll have a Q&A. We will have one last Anchorage Summer Session on August 8th at 8:30 p.m. Eastern. So if you guys want to join me, that'd be great. If you have any questions, there's a little hand icon at the bottom of your screen, Google Meet. Feel free to press that hand icon. If you just want to ask a question, you can unmute yourself and ask anytime. I'm happy to go through with you. If I'm talking too fast, please let me know. I have a tendency to talk fast, so please ask me to slow down or re-explain something. All right? We're going to take a look at SOXL in detail in this presentation. Today's IBD Market Plus, the S&P and NASDAQ tumbled today. Outlook is still 80 to 100%. We have one distribution day on NASDAQ, 4 on the S&P, and these were our leaders up in volume and the leaders down today. We had a pretty nasty beating for both TQQ and SOXL. This is where the LETF performance is year to date, courtesy of Google Finance. SOXL is up 121% year to date at the end of trading day, July 11. TQQQ is at 64.87%. ECL is at 68%. And FNGU is up 131% as of the end of trading today on July 11. So I wanted to put here, after my last presentation in June, a few people contacted me by email asking, what are the rules of this stochastic strategy? How does this whole thing work? And I had made the assumption incorrectly that some of you were familiar with the actual entry and exit rules for the strategy. This is a slide from Floyd presentation in September 2023 from the Alaska IBD presentation. This is the strategy for the weekly stochastic chart. As of September 2023, the rules of when to buy, when to sell. At the bottom of the slide, you can see where it shows preliminary SOXL variable, that is the primary SOXL variable, and the alternative SOXL variable. Those are the ones that Floyd and Rick tested that worked best for the Excel program. We'll be covering some of those today. I would strongly recommend that you take a look at the September 2022 presentation. You can always ask Floyd for it. He goes through it in great detail in terms of their setup, buying, stop rules, and so on. SOXL weekly primary inputs using an indicator release drawdowns. As we noticed today, on a really bad day, LETFs can have rapid moves to the downside. So the question was, can we use indicators to reduce the effect of this downside and limit our drawdowns? Now, there's a lot of different indicators, and I'll be presenting a new one that we found in August that's appeared right now to maybe do a better job. But for this one in July, we looked at what's called the Weinstein stage analysis on SOXL. For those of you who don't know what Weinstein stage analysis is, a method devised by Mr. Stan Weinstein back in the late 80s, early 90s, where, and typically this applies to stocks, but we're going to apply it to SOXL in this presentation, where buys are only made if the price is above the 30-week simple moving average or the 150-day moving average. We're going to check the results year over year, compare annual returns, P&L, drawdowns, etc. And we're also going to take a look at the total number of trades, the percentage of winning trades, and the CAGR performance. This right here is Floyd's original primary inputs for the SOXL stochastics. We have the full stochastics that he uses, 533, a daily stop of 17.7, a trailing stop of 28.4, a long from 12 to 100, and exit cross of 34. From January 1, 2013 to December 31st, these inputs turned $10,000 into over $1.3 million in that amount of time. So what we're going to do is we're going to apply a Stan Weinstein filter to these inputs to only execute a buy if all original conditions are met and the price is above the 30-week average. So for those of you who are familiar with Gary's TradingView script, this is what the entries would look like. You have your weekly full stochastics, you have the trailing stop, you have a daily stop, you have the overbought number, you have the longs entered between 12 and 100, shorts between 12 and 34, and the actual stochastic settings of 533. In the subsequent slides, you guys are going to see a column called account value end of year. In that column, you're going to play the actual dollar volume in the trading account. It's very simple to calculate. If there's no open trades in the last trading day, we simply calculate the value of the most recent completed trade. If there is an open trade on the last day of the year, we simply multiply the number of shares by the closing price of SOXL. For example, on December 31st, if your account had an open trade with 100 XL shares and the closing price was $1.10, then the account value at the end of the year is $1,000. We don't wait until the trade closes in the following year to calculate the account value. So the value in my column might be different from the one you get when you run your own TV script. Okay, so you guys were here last time. Don't be overwhelmed by this. We're going to go into a lot of details. When you view the presentation later, it won't be as confusing. What we're doing here is comparing three strategies side by side. There's two vertical gray bars. On the far left of the left gray bar, we have the buy and hold. In the middle between the two gray bars, we have Floyd's primary input strategy. And the right of the right gray bar, we have the same strategy, but with the 150-day moving average filter. We're going to go through this step by step, so don't stress out. At the end of 2013, we started on January 1, 2013 with $10,000. At the end of 2013, our buy and hold strategy has 25,688, a year over year of 106%. Floyd's primary strategy has made 60.66%, with it was a small drawdown of 7% only. And on the right, you have the same strategy with the Stan Weinstein 150-day moving average indicator at 88.45%, with also a small 7% drawdown. Does anybody have any questions so far about how I'm reading this, or if there's any confusion at this time? Please ask. I'll be happy. Go ahead, Floyd. Yeah, I can't hear if anybody has any questions, so I'll just go ahead. The next slide. 2015 was an interesting year. It was a very choppy year for SOXL. As you can see on the left, the buy and hold strategy lost about 20.5% at the end of the year. If you look in the middle section, Floyd's primary strategy was down about 13.5%. And our filtered strategy with Stan Weinstein 150-day moving average filter was down about 14.4%. But if you notice, the Weinstein strategy had a smaller drawdown. It only had a drawdown of 15.5%, versus in the middle, the primary strategy was down 27% that year in terms of its maximum drawdown. 2018, on the far left, we have a buy and hold has now lost about 40% that year, with an account value of $130,000. In the middle, we have Floyd's primary strategy that had a downside of 36% for that year, which is also pretty rough. A maximum drawdown of minus 36.52. And the far right, with the Stan Weinstein filter, we only have a drawdown of about 20.81% and a total loss of 14%. So as you can see, even though the standard YC strategy and the filter are approximately the same for value in account at the end of the year, the actual P&L is we have lost less in the filter strategy and we have a smaller drawdown also in the filter strategy. And now we come to 2022, as we remember, it was a very rough year for the bear market. If you had held on to your buy and hold, you lost about 85% of your portfolio. In Floyd's primary strategy, lost about 40% by the end of the year, and maximum drawdown was about 55%. And if you'll notice on the right side, we have a P&L of 21.88, and in the drawdown section, I have a not applicable. The reason you have that minus 21% was because at the end of 2021, which is the prior year, there was one open trade, and that closed in January of 2022. And that's where that loss happened at minus 21%. There were no other trades throughout the whole year of 2022. So the strategy using the Stan Weinstein indicator basically kept you out of that market for all of 2022 without executing any other trade. Does anybody have any other questions so far? Just check if there's anybody in the chat. And now here we are, 2023. Where a buy and hold strategy has gone up 226%. In the case of Floyd's primary strategy, you're up 82%, and you have an account ending with $1.39 million, a max drawdown of only up 32%. If you look at the far right, which is your strategy with the Stan Weinstein filter, you actually lost a little bit of money. You have a smaller drawdown of 18.99%. But if you look at your pound value, you only have $295,000 with this strategy, compared to the $1.39 million. The difference between the two accounts is substantial. If you look at the summary page, this will give you a better idea of what happened throughout the year in terms of the two strategies. With Floyd's strategy, you had a total of 46 round-trip trades versus 28 round-trip trades for the 150-day moving average Weinstein strategy. 28 round-trip trades is 56 trades over 11 years. So you're looking at 5 trades a year in total with the Stan Weinstein strategy. You have a max drawdown of, on the left, of minus 55% versus a max drawdown of minus 36%, which is what we've done and we've reduced. Floyd's original strategy has a win rate of about 56.52%. That means approximately 56.5% of the trades are profitable, versus on the right, you have 68% of your trades are profitable. And then you can see the average profit and loss per trade. And this will let you compare the compounded annual growth rate, is the rate of return required for the investment to grow from its beginning to ending, assuming all profits are reinvested at the end of each period. This is a good way to compare strategies and profits in equities because it irons out variability and volatility. Let's split this up into 3 different time frames. If you look by 13 to 23, the whole level year period, 17 to 23, which was the period of huge QE, COVID, and the subsequent bear market, and then 13 to 17, which was the earlier period before all that massive QE. We still have low rates, but we didn't have as much actual money being pumped in. So if you look across the board, the strategy in the middle, which is Floyd's regular strategies, performed better with a much higher compounded annual growth rate than the one on the far right with the 150-day moving average in all 3 time periods. Now, what was the conclusion from testing the 150-day moving average strategy? Remember, our goal is we're trying to figure out a way to reduce drawdowns and ideally not destroy our portfolio, not lose as much money. So the 150-day strategy did reduce the max drawdown. It had a higher percentage of winning trades, but at the end of the 11-year period, we have a final portfolio value of $295,000. The 150-day simple moving average had only 28 trades over 11 years, which is about 5 trades a year. What is the 150-day moving strategy? The 150-day moving strategy is the Stan Weinstein strategy where you only purchase the ticker if it is over the 150-day simple moving average. Otherwise, you don't purchase it. And you sell it when it goes underneath that. When I put this strategy together and presented it, I talked to Floyd about it. Floyd said, why are you presenting a strategy that is not making as much money, that is performing so poorly compared to the regular one? Why would people be interested in this? My answer to him was, there's 2 or 3 reasons I'm doing this. One, is I don't know what kind of investor we have watching this now or later. Investors might be extremely cautious. They might want to trade very little, and they don't mind getting 30 times their money versus 130 times their money, if that means losing a lot less money. But the bigger question I had was, if I had picked the 150-day strategy, the one that only returned $295,000, how would I have compared to investing in any of the other FANG stocks or the Magnificent Seven stocks in that same period of time? Well, let's take a look. The account value of the 150-day simple moving average strategy was $295,000 from January 1, 2013 to December 31st. If you had invested in Apple, Microsoft, or Amazon during that same period, you would have made less money, actually maybe half the money you would have by just investing in the 150 moving average weekly strategy. It would have beaten those 3 stocks. And you would have had a similar drawdown to Apple or Microsoft and a much better drawdown compared to Amazon. You notice on the far right, Amazon had a drawdown of 52%, whereas the 150-day strategy only had 36%. Mark Smith asks, can you show how one of these strategies function, as in when you buy, when you've exited? Is this just a report or are you learning something? I hope you're learning something. It is a report. The entry and exit rules were right at the beginning. If you looked at the slide from September 2023, where Floyd and Rege went through all the entry and exit rules, I'd recommend you take a look at the presentation from September 2023 that shows the weekly entries and exit rules. They're also in the earlier slide in this presentation, which I'll take you back to a little later. Same thing, we're going to compare, again, with the rest of the FANG strategies. Same strategy on the left, our SOXL 150-day, compared to Meta, Netflix, and NVIDIA. We still beat out Meta. We came relatively close to Netflix returns, but keep in mind, Netflix lost over 74% of its value, whereas our strategy only lost 36%. And then we have NVIDIA, which did phenomenally well in 2023 at 1.7 million, but it also had a drawdown of about 62%. Aside from NVIDIA and Tesla, the SOXL primary strategy of the 150-day, even though it earned less money than a regular strategy, still beat out almost all the Magnificent Seven stocks over that 11-year period and had a smaller drawdown as well. Do we have any questions so far? Am I going too fast? Do I need to go back to any of the slides?
Hey, Rege, I understand you compared with the Mega 7 and SOXL, but that's not really an apples to apples comparison because SOXL is a leveraged ETF versus others are actual stocks. They have earnings every quarter. SOXL doesn't have earnings. Most importantly, when Excel goes down, especially the leverage, especially when the market is bad, it is prone to splitting and reverse split. Stocks do have the same thing as well, so we can compare. But apart from that, what was the intent of comparing individual stock with SOXL? Because the volatility in individual stocks is a lot more compared to SOXL.
You said the volatility in individual stocks is more compared to SOXL?
Yes.
Okay.
Because SOXL at the end of the day is the basket, right? It's a leverage, but it's based off of SOXX, which is the basket of semiconductor companies.
You know, I don't know if you've taken a look at, Gary, I'll get to you in a moment. I see your hand raised. I'll get to you in a second. If you look at Apple, Amazon, Microsoft, Meta, possibly Netflix, the moves for SOXL, because it's leverage, are much higher and far more volatile than any of those big cap stocks. If you had a day where SOXL was down almost 10%, I can't remember when Microsoft or Apple or Amazon or Meta go up and down 10% in a day. And SOXL does that pretty regularly. But SOXL is a far more volatile stock because of its leverage compared to any of those big cap stocks. Tesla and NVIDIA might have some days, but SOXL does have a lot of volatility, often exceeding 7 to 8% moves in a day. So I don't agree with you there. The point of comparing those was because when I applied the Stan Weinstein 150-day SMA filter, we reduced the drawdown significantly, but we also reduced our final return compared to the 1.39 million at 295K. if you have put in a filter that reduces your drawdown, reduces your return by that much, you have to ask yourself why you can bother doing that and just take a higher risk. But you have to compare the risk, the lowered risk and a lowered return. What would have happened if you had held a paying stock?
I agree with your point about the day-to-day volatility of 8 to 10% in SOXL because of its leveraged nature. But a similar volatility event happens for Apple, Meta, any other of the 7 mega stocks when their earnings are raised. They can take a 20% hit on earnings day. But your SOXL may not be down that much because it's a basket of security.
You have talked about the split, reverse split, I think in every presentation that we have. You're right, because if we have a year, say 2008 or 9, we might have to deal with a reverse split. But since these ETFs launched in 2010, in spite of the bear markets, the COVID drop, the 2018 drop, we have not had a reverse split. We've actually had forward splits, but with increase. Now, it's possible that it might happen in the future. We might have a reverse split if we have some crazy time like we had in 2007, 8, and 9. Until that happens, unfortunately, I'm in no position to theorize what might happen. All I can say is I hope that you or I are not in it or are able to get stopped out and stay out. But we'll find out when that time comes. Gary, go ahead. Did you have something to say?
Yeah, I just want to be clear. Every time we re-enter a trade, we're re-entering with the total amount that we carried from the close of the last trade.
That is correct. As far as the strategy slide from Floyd's presentation in September 2023, I recommend to all of you, if you don't already have it or have not read it, please go back and take a look at that presentation and the slides from September 2023 for IBD. Yes, every time you sell, whatever profits you've made, you reinvest them into the next bot. That is how these numbers are calculated. Did that answer that question, Gary? Or do you have another question?
It's not just the profit, it's the initial
Yes,
investment.
the total account, whatever it is, everything's being done. Yeah.
That's the way I understood it. I just want clarification on that.
All right.
It's,
Let me go forward a little bit to
I've got a comment here, Floyd. I had a recent question from one of our IBD Meetup members about our strategy. A few days ago, SOXL, the fast line, had dropped below the slow line, and the member emailed me and said, since the fast line is lower than the slow line, does that mean I need to sell SOXL? I said, if you're following our strategy, the answer is no, because there is a two-part requirement. Not only does the fast line have to be below the slow line, but it has to go all the way down to whatever variable we want to use. For example, if we're going to say 34, you let the fast line continue to drop to get down to 34. So both conditions have to be true to do a sell. It might be helpful if you let me share my screen and I could show Thinkorswim, which a lot of people use. I could just show SOXL and where we made a couple of buy and sell decisions. Would that be
helpful? Let me just set this up so you can
help me figure out how to share the screen? It might help people visually understand what it is we're doing here. So it's just,
I'm going to stop presenting and hand this over to you. Let me see if I can stop presenting. Okay. Floyd,
where is that present button? Let's see.
It should be a little square with an arrow on it. You see it?
It says, no, I'm not allowed to share. So maybe you need to make me like a coach or something.
Yeah, let me check. Fortunately, I'm not even learning how to do this part in through the co-hosting.
The way we do it on Zoom is click on my name, and then there's probably an option where you can say make co-host.
No, it's the way this meeting's set up, but I don't think I can set up a co-host right now. Here we go. Okay, Floyd, is that button changed for you?
Yes, it is. Okay, now it's share. Wow. Okay, so let's share. Let me see, choose what you want to share. Well, I guess I'll share my window. And tell me if you can see my Thinkorswim window.
Not yet.
Okay, I'm showing my Thinkorswim window. Let's see. Entire screen. Let's go like this then. Do you see Thinkorswim now?
No.
Operator error. How about now?
No.
Looks like it's trying.
Okay, let's try it one more time.
Did you try sharing the entire screen option on the share?
Yeah, I said entire screen. Let's see, share. Entire screen. Let's try share window maybe. No, let's do the entire screen. And I'll hit share. Does it work now?
Yeah, it looks like something's happening.
There
we go.
A lot of us are using TradingView now, but a lot of people I know also use Thinkorswim, and that's what this is. This is a weekly chart for SOXL. And this is the full stochastics line down here. So we have the fast line, the slow line. Here's a couple of moving averages. So you can see for recent conditions back here on the week of, I think that was like a November 3rd, I believe was we had a buy signal. And that's because the fast line moved higher than the slow line right down here. We stayed all the way in. We finally got a sell signal over here in, I think it was in March. Fast line, not only did it drop below the slow line, but we waited until it got all the way over to here. And you might say, why would you wait that long? It doesn't seem intuitive. Why didn't you sell way back over here? That's a good question. We've done thousands of back tests. Very rigorous testing. Thanks to the hard work by Rick Kelleher, he developed an Excel program that had 210,000 equations, which sort of blows my mind. And when Gary introduced it to TradingView, we can do very rapid back for SOXL using a weekly strategy. If you wait until the fast line gets all the way over here, over a period of time, and make more money. So look what happened in January of this year. The fast line crossed below the slow line in very late December. If you were using a daily strategy, you would have sold. But with the weekly strategy, our fast line did not get all the way down. So we hung on. And from this point to this sell point, that's about a 50% profit. You'll notice that we avoided some pretty heavy duty drawdown. And then we bought again in April. And using the weekly strategy, and that's because right here, fast line went higher than the slow line. With that buy we made in April, we have not had a single sell signal, even including what happened today. Look at today. Today, SOXL had a pretty heavy duty drop on a daily basis, but for the week, it's no lower than I think it was on Monday or last Friday. And so if you'll notice, even with today's big drop on SOXL, the fast line is still higher than the slow line. But what Rege has done is he said, if you want to look at an alternative strategy and you want to have a secondary indicator that would determine when you buy and sell, if you want to use a 150-day moving average, that is on top of the things I just showed you. What it does is under conditions when the market isn't looking so good and SOXL is below the 150-day average, the rule kicks in and says, even if you get a buy signal, you can't buy if you're below the 150-day. You'll notice on Reggie's analysis, without that prohibition of trading, we made about $1.4 million. But we had some pretty good drawdown in there. But the bottom line number is we ended up with 1.4 million. In a Reggie's example, when you put in the 150-day moving average as a secondary rule for when you can buy or not, the end result, instead of having 1.3 million, we ended up with about 300,000. So I think that's all I'm going to say, Reggie. I hope this example shows people that following our strategy and using stochastics in the position of the fast and the slow line since last October, or excuse me, early November, we've only had 2 buy signals and we've only had 1 sell signal. So to me, for my personality and way of trading, I like a system that doesn't require me to trade and buy and sell every week or even every 2 weeks. The reason I like the weekly strategy is I may only have to make 3, 4, 5, maybe at most 6 decisions a year or so. And maybe on a really crazy year, maybe it's 7 or 8 decisions. And I'm willing to take slightly less profit than I would if I went to the daily strategy, which requires me to trade a lot more times. Reggie, this is your meeting, but I hope that this little visual example using Thinkorswim shows how we use stochastics to make our buy and sell decisions. Okay, that's all I'm going to say.
Thank you, Floyd.
Hope that helps. And I think you might have had a few other people with questions.
I'll get them in a second.
I was a little surprised today when I saw a pretty steep sell-off in SOXL, and I went and looked at my chart, and the fast line was still higher than the slow line. Now, that's not true for TQQQ or FNGU, but for SOXL, I thought that fast line would have been lower. It'd be interesting to see what happens tomorrow, but we're not in a prediction game. We're in the interpretation. Today really didn't scare me that much, frankly. You don't like to see things go down, but we've been overdue for a pullback anyway. For something to go up more than 100% since January was pretty hot. Don't be surprised if we have days like today. Historically, in the presidential election year, and with such a big run-up, the second half of the year, if you follow history, December should be higher than it is now. Reggie, go ahead. I love what we're doing here.
Thank you, Floyd. All right, folks, anybody have any questions about anything that Floyd has talked about or anything that I've covered, please unmute yourself and ask or raise your hand. Go ahead.
Reggie,
Yes, ma'am.
this is Cookie Corey, and I have a question. Not about anything that you have already presented, that I think that you might want to look into. And looking at the difference between SOXL and FNGU. FNGU was up 140% year to date. So that's taking the FANG stock collectively and leverage as opposed to taking them individually.
Last year, FNGU was up 460%, which blows my mind. I even called the Bank of Montreal because FNGU is not an exchange-traded fund. It's an exchange-traded note.
ETN.
I had to get transferred to about 6 different people before I finally got to a guy that knew what I was talking about. He gave me the name and phone number of a couple of guys down in Florida that actually manage FNGU for the Bank of Montreal. I congratulated him on the 460%, and I said, well, don't expect to see that again. Cookie was saying up 140 or 50%. It dropped like $60 today, I think. FNGU only owns 10 stocks. It's very concentrated. So if you trade any of the leveraged ETFs or ETNs, go to the parent company page and investigate and make sure you know what you're investing in. FNGU had a little bit of a problem here a month or two ago because snow dropped like a rock, and FNGU was under pretty serious pressure there for a while. So know what you own.
Thank you.
All right. To answer your question about FNGU, the reason I didn't compare it, FNGU is a relatively much newer ETN. It only came on the market, I believe, in February 2018. I don't have enough data on it to go back all the way back to 2013 or 2011 or 10 to do another comparison historically. So that's why I didn't want to enter it in the system here. But does anybody else have any questions?
Just another minor nuance out there, Reggie, is the old XXXX, which is now SPYU, is the S&P 500 times 4, and that is also an ETN like FNGU is, and most people don't know. On ETNs, you can't buy and sell options like you can on ETFs. For some people, that's no big deal and they don't care. For other people, that might be something they would want to consider whether they would want to own one of those or not. So just like I said earlier, know what you're investing in and know whether you can do options.
Does anybody else have any questions or comments on anything that's been presented so far? Just to recap, the last one says support for the investor to test multiple indicators individually or in combination to come up with test results to best serve the investing style. You have to figure out what works for you, your personality, and then decide how you want to proceed. So this is what we've learned from indicators so far. Lots of clarity for your analysis. Next slide. In June of 2024, Gary and Floyd's team showed us some promising new inputs for SOXL. We've modified the weekly strategy and sent me some daily inputs as well that had very good historical performance. For those who want to test it out in these two columns, the new weekly versus the new daily, one uses full stochastics weekly, the other one full stochastics daily. From January 2013 to December 2023, the above weekly strategy. Okay, so in the TradingView application, it's a set of inputs that you can apply. At this point in time, the TradingView app is not set up, the script is not set up to actually go short, but it is simply a way to get out based on those inputs that have been entered into the short line there. If I'm not making a lot of sense, what I will do is, if you want to submit your email address into the chat, I will send you a link from February or March of this year where Gary Taylor goes into a lot of details into where those inputs go into the TradingView script so that users such as yourself can test them out and understand what they are. It's a little too much to cover here because I have to go back to TradingView script, but I can send you those details with a very detailed explanation if you want to put your email address in, or contact me at omginvestors@gmail.com. I will get that presentation out to you.
Another way to look at it here is we're not shorting SOXL. Instead of the word short, put in the word sell, and the word long, put in the word buy. So you would sell SOXL when the fast line drops down to 32. That would be the get out period. After you get out, you can buy when the fast line is between 12 and 80, for example. And the word short here is probably misleading. I'm glad you asked the question, Watson.
I will make those changes going forward. Watson, like I said, if you want to email me at that email at the bottom, omginvestors@gmail after this presentation is over, I will hook you up with Gary to get you a link of that presentation from February or March of this year with all the details in. Anyone else have any questions?
One more quick question.
Sure.
Cross, is that another decision point?
Yes, it is. Earlier when Floyd was showing his Thinkorswim script, he was showing how even when the fast line goes underneath the slow line, he doesn't sell right away until it goes all the way down to a certain point, and that point is the exit point. That's the exit class.
So it's the same as sell 32, one high, one above.
It is for the weekly in
Yeah.
this case, but it's not always the case for the daily.
Thank you.
These new inputs from January 2013 to December 2023 for the weekly turned 10,000 into over $2 million. And the daily inputs from the same amount of time turned 10,000 into over $5.5 million.
Quick question. Is it
Yeah.
January 1st? Oh, 2013. My apologies.
No, it was not in 1 year. It was 11. Let's take a more detailed look.
It's the same time frame as your previous example, right?
Yes, they're all from the same time frame from
Yeah.
January 2013.
11 years.
So this is the full tabulation set, which when you go back to this presentation later on, you can look into in detail. Again, it's divided into 3 sections. On the far left, we have the buy and hold. In the middle of the 2 gray bars, we have the new weekly strategy with the new inputs we showed earlier. On the far right, we have the daily strategy that we showed a minute ago. Just so you guys see, it's 18-14-4. I realize I have a typo on this screen. It should be 18-14-4. Please keep that in mind. I'll make an effort to correct that in future slides. All right, so let's take a look at 2013. So at the end of 2013,
Reggie, go back. Notice on the bottom line, your buy and hold, not a bad deal. Your 10,000 turns into 750,000, but at one point it was 1.6 million. In 2022, it got killed. But notice with this revised strategy, the weekly gives you about 2.5 million instead of 1.3 million or so. Daily ends up with a whopping 5.6 million. But look at the line where it says on the weekly strategy, in those 11 years, we had 52 round trip trades or 104 buy and sell.
wide open. Come on, say something for me.
I can't help myself, buddy.
All right. Okay, folks, now that Floyd's ruined everything, I'll go through it again. I'm kidding. Let's go through this. 2013, as we start off at the end of 2013, our buy and hold strategies at 25,600. The new weekly inputs have earned us 106% that year, but our daily has only made 32% at 13,265. I picked these years for a specific reason because I want to look at the nasty years more so than the great years, because that's what really hurt. So 2015 was one of those nasty years where the buy and hold was down 20%. The weekly strategy was only down about 13%, and the daily strategy was down about 21%, which is the same as the buy and hold. So if you notice, the buy and hold is still outperforming. The weekly strategy is doing decent, but our daily strategy is lagging. We skip ahead to 2018, which was another nasty year. And I want to take a look at what's going on here. The buy and hold lost 40% that year, 39%. The weekly strategy with new inputs was also down 36%. But if you look on the far right, the P&L was up 76%. So if you look at the actual account values at the end of the year, the daily strategy is almost caught up with the buy and hold. This was the same one that was trailing in 2015 that has now jumped ahead in 2018. And as Floyd mentioned earlier, let's look at 2022, where the nasty year, SOXL lost 85%. Your account dropped from $1.6 million down to $230,000. The weekly strategy, which was the new inputs, was down about 21%, but still at 1.2 million. In 2022, the daily strategy was again up 35% over 3.1 million. So I want you to think about this. Imagine you're a trader 2022 and the SOXL is dropping, losing 85%, and you're trading the same ticker with different inputs, and you're up 35% that year. It's pretty impressive. And of course, as Floyd pointed out earlier, at the end of the whole 11-year period, on the far left, you're at $707,000 in the weekly strategy and about $5.6 million with the daily strategy. And we're going to take a look at the summary. This is the part that Floyd had talked to me about a couple of days ago. Floyd personally does not like trading a lot. He prefers fewer trades. As you can see, the weekly strategy only had 52 trades across 11 years. With 52 trades, about 100 total trades, because you have to multiply by 2 across 11 years, you're looking at less than 10 trades a year, which is maybe 1 a month. Whereas if you look at the daily strategy in that same amount of time, you'd have a total of 215 trades, 15 round trip trades, which adds up to about 430 total, which comes out to about 39 trades a year. 39 trades a year is a little over 3 trades a month. So here's a question you have to ask yourself. Are you the kind of person that doesn't mind trading a little over 3 times a month? Or are you the kind that prefers to trade maybe once every 2 months? How active you are, how active you want to be. Because in this case, with these inputs, in this time period, the difference paid off significantly. You also notice that the maximum drawdown for the daily strategy was a little bit lower than the weekly at 44.4 versus 55.5. And the win rate was, well, in most cases, they were close to 50%. So a little higher for the weekly strategy. And if you look at the CAGR, which is the compound annual growth rate, the part I want to focus on here is, if you look at the first line, obviously we know that over the whole 11-year period, the daily strategy on the far right performed the best. But if you look at the bottom, which is from 13 to 17, those first 5 years, the daily strategy was performing the worst. Okay. So this is a strategy. Is it possible to keep up with a strategy when you see something else doing better? From 17 to 23, you're getting CAGR about 104% a year, handily smashing the other 2 strategies. You have to ask yourself, if you have a strategy that's proven itself, can you stick with it? How much do you want to trade? What kind of drawdowns are willing to accept? Again, that's all depends on the personality of each investor and trader to decide what's best for them. Okay, so here we go. This is the strategy. 52 round trip trades in 11 years comes out to about 9.5 trades a year. So 1 trade approximately every 6 weeks if you are in the weekly strategy. Whereas if you look at the daily strategy, you have a total of 39 trades a year. That should be 3 trades per month, not 39 total trades per year. Looking at about 3 trades from January 1 to June 30th, because the past 6 months of this, first 6 months of this year, the weekly strategy had a total of 4 trades, where the daily strategy had a total of 24 trades, which is about 4 trades a month, 1 a week. You have to figure out is, are you more comfortable trading that frequently, or do you rather trade a lot less? That's a decision for you to make individually. How do I get a copy? Mark, you can either email me at this email. I'll send you a link to view the slides and the copy of September 2023. Gary asked me, what's the point of going to these tables? I think Mark asked earlier too, what's the point of this? Are these details of any benefits to participants? Will it help improve their trading results? Every 2 weeks, Gary and Floyd and other people on the research team use the TV script to maximize results, ideally to minimize drawdowns. They were kind enough to share the most recent inputs with me before the presentation so I could put it together, do all the back testing, and present it to you. So what is the point of presenting this to you? Each of you have to decide what's most important. Is it your final portfolio value? Is it the number of trades? Is it the max drawdown? Or would you rather just buy and hold because you don't see that much of a benefit? I encourage all of you to use the TV script as a tool. If you guys want to reach out to Gary Taylor, he's, I believe, very friendly, very helpful. And if you guys find that using the script, you find some amazing results for backtests, feel free to share them with us. I'm more than happy to give you full credit, present them here, and give you a whole slide dedicated to thanking you. So before I go forward, do we have any other questions at this point? If anybody has any questions, just unmute and ask or raise your hand. I'll be happy to answer them. The drawdowns versus losses, understanding the difference. I'm sure most of you already know this, but I just want to cover this because I'm not sure if everybody's familiar with it, but it does matter. This is an example of sample stock in any given period. In this case, it was just a random stock from January 1st to March 1st. We buy the stock at 1,000 shares at $10. We start off with $10,000 invested. On February 1st, our portfolio hit a peak value of $25,000, which is 1,000 shares times 25. On February 15th, our portfolio hit a trough value of $11,000, and our indicators told us to sell at that point with a total portfolio value of $11,000. So what was the drawdown and what was the loss? A drawdown is the reduction of investment after a series of losing trades. It is calculated by finding the difference between the relative peak in capital minus the relative trough. The initial portfolio value was $10,000. The relative peak was 25 grand. Subsequent trough was $11,000. And so the drawdown is calculated as peak minus trough divided by peak. In this case, we had a total drawdown of 36%. 25 grand minus 11 grand divided by 25 grand is 56%. But a drawdown is not the same as a loss. Drawdown is a reduction in value, whether you realize it or not, or the loss of the actual amount of money that you lost. Our portfolio actually had a realized gain because we sold it at 11,000, bought it for 10,000, we actually made 10%. I wanted to focus on this because I'm going to go back to the same slide we saw before, but I'm going to have a separate column just for losses because I want to make sure that everybody sees this. Okay. Same slide, same inputs. Floyd's the new inputs for the weekly, and Gary's 14.4, not 18.44. And we'll take a look at this in a little bit of detail. So in the first year, for example, here we have, you look at the middle two columns. We have the weekly strategy where we had a yearly drawdown of 4.08% that year. We had no losses in the account and a total upswing of 106%. You started the year with $10,000. That means at no point in that whole year did your account go below $10,000 with no loss realized. If you look at the daily strategy on the right, we were up at the end of the year to 32%, but the maximum loss throughout the year at any point was a 10% loss from the beginning of the year. Even though the drawdown was 16, the actual realized loss at any point was only 10%. Here we have 2015, another choppy year. In our weekly strategy, we have a loss at the end of the year of 13.5%, a max drawdown of 27%, and the actual account had a realized loss of 20% from what it was at the beginning of the year. We ended the year down at 21%. Our drawdown was 43%, and a max account loss was 35%, which is pretty significant. Even though you were down 35%, at some point in the year, you ended the year back up. You're only down 21%. Does anybody have any questions as to what this means? 2019 was a bumper year for SOXL. And in the weekly strategy, we had a max drawdown of 31%, yet our account had no loss that year. So from the start of 2019 to the end of 2019, you never realized a loss, and you made 276%. Similarly with the daily, if you look at the daily, you were up 334%. You had a max drawdown of about 15%, but again, your account never had a realized loss. Okay. 2022. 2022 was a rough year all around, but I want to look at these strategies specifically. The weekly strategy had a max loss of 55% and a max loss of 49%. That's important to understand because at some point, whatever account value you started with, somewhere in the year, you were down, you lost about 50% of it, realized loss. Even though you recovered that to end the year down 21%, this is what the actual realized loss was in the middle of the year. If you go to the right here in the daily strategy, you had a drawdown 44%, but a maximum realized loss of 32%, only to be up the year at 35%. This is important because as you're trading throughout the year and you're down realized loss of 32%, would you be able to keep trading it? Because at the end of the year, you were still up 35%. And finally, at 2023, here again, this is very interesting because on the weekly strategy, we ended the year with a 93% gain. We had a 50% drawdown, but no realized loss that year. And similarly for the daily strategy, you had your 82% gain, a 20% drawdown, but actually no loss at all. Does anybody have any questions so far? Barry, go ahead.
Clarification. The 49% is the maximum realized account loss. Was that during multiple transactions?
Yes. Basically, in the case of the weekly strategy, one of the things that you have to realize, whether it's this weekly strategy with the new inputs or Floyd's original, is that Floyd keeps a daily stop of 17.7%. For this strategy, the daily stop is 19.3%. So if you think about that, you can have a series of stops that will bring you down to that amount. In general, a series of losing trades will have an account loss ending at somewhere in the year of about 49%.
Well, if Floyd, in 2022, we had 4 or 5 losing trades in a row, which really got our attention. And we're going to be making a presentation in August or September that, with the help of one of our members, helped us identify a factor that eliminated that 49% drawdown. To answer the specific question, that 49% was not one bad trade. It was probably 4 bad trades in a row because 2022 was a challenging year.
Is that answer area?
Yeah, it does. The PD 19.3 at the top.
Yes.
Is that one of the additional sell rules that if you go beyond, is that what that's referring to?
That is a sell rule. That is a daily stop. Anytime you enter a trade, you set a stop loss of
from the previous day's close. My brain is saying, wow, 19.3%, a trailing stop of 28. Those are big numbers, but we've run thousands of back tests. And for reasons I can't totally explain, if we try to optimize those numbers and change them, maybe say, I only want to draw down of 15% instead of 19.3. At the end of 11 years, instead of having $2 million or so, you might only have 700,000. You really have to do the back testing to prove to yourself from real numbers what are, because of the behavior of how fast SOXL can move up and down, what factors help us maximize our performance.
And to add to that, Watson, if you look at the columns on the right of the right gray bar, which is the daily strategy, that should be 18.14.4. That has a daily stop of 6.8% and a trailing stop of 13%, which is a lot tighter and smaller than the weekly one. And that's one of the reasons why you also get that many trades, because with SOXL and its daily volatility, very easy to hit. Like today, you would have hit that daily stop because SOXL was down something like 9.8%, but the weekly stop you would not have hit. You would have just, oh. Watson, did you have a question?
Yeah, just want to confirm, in Floyd's weekly strategy, in addition to this one stop, there's also a trailing stop, right?
Yes, that is correct. And Floyd, did you want to explain that? Because we covered that in this. Go ahead, Floyd.
Yeah, the trailing stop is 28.4%. The way that works, the first day you buy the stock, and you can have 19.3 or 28.4 and they get you right out. Let's say the SOXL moves up and goes 100% in value, like it has. Then you take, and I've owned it now for several months. So you go back and look at the highest intraday price. I don't know what that price is, but let's say it's 68 or 70. You take the highest price and you subtract 28.4, and that becomes your sell signal. And until you get a higher intraday price, that previous price is what you use as your benchmark for when you have a trailing stop. So did I explain that enough that you understand that?
Watching a slide from the September 2022 rule, and if you look at sell rule 3A and 3B, which it puts in the word what Floyd is describing verbally. And again, if you don't have a copy, you can either email me or Floyd.
Or take a photograph with your iPhone.
This presentation and all the slides will be available for you within the next couple of days. Also reach out to me or Floyd if you want a detailed September presentation video and slides.
Thank you. I just wanted to reconfirm.
No problem.
There are two stops, one a one-day drop sell as well as a trailing stop.
Yes, that's exactly correct. If you don't hit the 1 day or the trailing stop, the other signal is if the fast line drops down to 34. So you have three different scenarios that could cause you to sell SOXL: the PD stop, the trailing stop, or the fast line drops down to 34.
Actually, Floyd, to add to that, there's actually four, because if you decide to set a profit target, you have to set that too.
That's right. On the advanced strategy, on the weekly strategy, when you hit 69% profit.
And for the daily strategy, if you look at the top of these tables, there's a little thing saying PTGT. Something's there. Just 1 second. At the top, you'll see a PTGT of 69% for the weekly, and a PTGT of 33% for the daily. Those are profit targets. You decide these profit targets were also, I didn't have time to backtest all the different profit targets, but I had to put this presentation together. So for these strategies with these inputs, profit target was one of the inputs as well. So when you buy, if it keeps going up or sideways and up and sideways, at some point, if you hit 89% profit target, you automatically sell it. And then if you decide whether or not to get in based on that rules in that slide again, there are multiple exit rules.
Yeah. If you were to sell with the 69% profit target, then for you to get back into the strategy, do you have to wait until there is a sell and a buy again?
You do not. No. The answer is no. It's counterintuitive, but when you sell at 69%, if the fast line is above the slow line, you buy it back maybe the next day. It seems counterintuitive. When you are back testing. Originally, we had to take a profit at 40% on the weekly, and I kept playing with back tests, and I got up to 69. It's a personal choice. You have to look at your own personality, account, and trading behavior. If you take a 69% profit and you're happy with that, and you want to take a break, that is your own personal decision. And you could wait until we get a sell signal and a new buy signal. But the way the rule works, if you take a 69% profit, and if we're still on the buy zone, you're allowed to buy it back.
Got it.
What's the purpose of that? Of the PTGT? If you're reinvesting immediately after you sell, it's not like you're compounding because it's already invested. So what's the purpose of selling and buying back?
You mean why set a profit target at all? Is that what you mean?
Yeah. Why sell it at all?
So I can answer this question. For these two strategies, I have not had time to go through the backtesting. In my previous June presentation, I ran the details for PQQQ and showed you how for Rick's alternative inputs, there was a specific profit target of 2024. I backtested it with no profit target, and then profit targets all the way from 5, 7, 10, 15, 20, all the way up to 45 to 55%. And I was able to consistently find for those specific inputs, by setting that specific profit target, yielded the best results. It performed better by setting a profit target than without one. Much better, almost double the account value.
I can think of, I guess if you rebuy it next day or whenever, then I think the stop, one-day stop, those numbers could change, could have impact, or maybe not.
Gary, did you have a question? Because I know you were waiting earlier.
I have a couple questions. You're selling midweek. If the stop is hit, you're not waiting till Friday. Is that correct?
Are you asking about the weekly strategy?
Yes.
Floyd, did you want to answer that?
On the PD and the trailing stop, if you hit those, you sell. But if you're using the fast line only, if you're waiting for the fast line to give you the signal because you haven't hit the PD stop or the trailing stop, you wait until just before the close on Friday to confirm that you have the sell rule. Now, it's up to you. You can say, that's crazy. I don't want to wait that long. So you can do an early sell if you have whatever your personality or intuition or whatever. But the way we back test it, which may not be exactly how you trade it, is we wait for the fast line to get the true number on the Friday close. On a weekly strategy, when we do back testing, the weekly value is calculated once a week based on the Friday close. Think or swim, that fast line moves intraday all day, every day, especially if there's very much price action going on. If on a Thursday morning we see a bad market action and the fast line went from 45 down to 34 in one day, the Dow's down 500 points and the Nasdaq's down 300 points and the news isn't good, you might say, this is crazy. I'm not waiting until Friday.
Gary, to answer your question, which if the daily stop hits, you sell. Is that what your question was?
If your trailing stop triggers on a Wednesday,
Yes. If
just selling.
or like the PD stop, let's say Monday, there's a big gap down on Monday and you're down the PD stop amount at the close on Monday. Absolutely. You want to sell.
Set your trade to execute whenever that number hits. You don't have to wait till the end of the week.
And then you can always get back in.
Right.
Now, if there's a little bit of personal preferences here, so we're showing you some very rigorous mechanical back testing results. Nobody on this call, if they had $10,000 and started back 11 years ago and we all went away and came back, none of us would have the same final number. We're giving you mechanical back testing results that said if you were following that strategy, this is how it would work out. You have to be careful if you rely too much on your gut or intuition and don't follow any of the rules, then chaos could occur. So we want to use this as our anchor and the basis of how we're operating. For example, on November 1 of last year, the market decided it was tired of being in a downtrend and it said, hey, I want to get into a new uptrend. And so there were some killer strategies to buy on Wednesday, November 1 on TQQ and SOXL. But if you followed our rules, you would have waited until near the close on Friday, just 2 days later. But to give you an example, on TQQ, I bought on November 1 and I think I sold on March 15 and I made 72% profit. The guys that waited until Friday to buy and then sold on the same day I sold, I think they made like a 56% profit. And so just those 2 days was a big difference. But I cheated and I bought on Wednesday knowing I was increasing my risk. If it was a head fake and I got a sell signal, I would have to sell and get out. And so I told myself I'm willing to take the risk because I'm doing a little bit of a cheat trade and I got in about a day and 3/4 early, but that was just a personal decision.
Does the back testing strategy take into account the opening price, regardless if it's a gap up or a gap down the following Monday? You get a signal on Friday. When you input that, is it taking those variations into account?
I don't think we get so granular where we look at the price every minute or every 5 minutes. Open, high, and close. So on the open, if there's a gap down, the model will have a sell. We look at 3 prices, open, high, close. And if at the open, we hit the PD stop, then the back test would take us out.
Do we have,
That's really rare. If you get one of those PD stops, we're probably in a terrible market, like what happened during the COVID crisis. And you got to think you're lucky stars you got out, because we might have 5 or 6 or 7 bad days in a row.
do we have access to the TradingView program, or is that exclusive to Gary?
No, if you contact Gary, he will link you in. In fact, we have about 40 users right now. We're encouraging to backtest the heck out of the thing. Recently, we had a member notify us of a new indicator that is just blowing my socks off. It turned $3 million into $10 million with one simple indicator. If you get a hold of Gary Taylor and say you want to be in the user group and do back testing, he'll give you access to the code for 60 days. If you want the TradingView training, he did a really good session on the December meetup. Gary has presentations on how to use TradingView also. Gary Taylor, it's at PV Trader, and Trader doesn't have the letter E in it. Is it at gmail.com, Reggie?
Yeah, I think it's gmail.com.
Yeah, PV Trader with no E in the word trader at gmail.com. And if you say you were on the IBD meetup tonight and you heard about TradingView and you'd like to get the code so you can do back testing, and if you want to watch any of the videos, Gary can help you with that.
Reggie can get back on.
Gary, listen, we don't have creative authorship here. The guy's name is Chad, and we're going to give him credit in future presentations. A backtest strategy that works better than what we have. We'll give you full credit for it, and we want to know about it, because we're sure there are better ways to do things out there, and we're going to help each other out. And if you figure out a way to help us trade smarter, we'll share it with everybody on Meetup.
Okay.
Does anybody have any other questions at this time?
This is Laura. I just typed one in the chat. I was just wondering, I think earlier Floyd used it, buy on the daily and sell on the weekly. I didn't know if that was ever back tested or if this was something that was just before the back testing.
That's the example that I gave when I bought on Wednesday, November 1. I was looking at the daily price action, and I called it a bit of a cheat trade or an early trade. I was still watching weekly and looking at the weekly trades. And then when I was telling people when the buy signal was, I gave it on Friday, November 3. But when I was looking at the daily action, I was willing to take the risk, and I bought it on Wednesday, November 1. So does that answer your question?
Yeah, I understand that. I think before all the TradingView backtesting, when you used to just hand do the stochastics with MarketSmith, you used to do the buy on the daily and sell on the weekly. So I just didn't know if that was ever tested.
The reason I say no is we're trying to keep things relatively simple and the rules to be pretty straightforward. But as an individual trader, you can do a hybrid of these things. And if you do that, I would encourage you to back test it and think about it. But we're just shining a light on a strategy here, and then each person can decide how they want to implement it. I hope that helps, Laura.
Yeah, thank you. Appreciate it.
Somebody asked in the chat, will there be a summary slide of the most updated TradingView settings for TQQ, SOXL daily and weekly? The answer is no, because the ones I'm presenting to you, for example, in this slide, presenting 2 new inputs, I don't have a summary slide. You can always go back into the presentation here to the slide where it actually shows you the inputs and apply those. Every month, every few weeks, people like yourself who are using the TradingView program, coming up with tweaks and improvements all the time. So we try to share them as quickly as possible. Next one, August, Floyd mentioned this new indicator that somebody in chat had found. We have to go through those in more detail so I can present them to you with proper backtesting. Those inputs might be modified. The most updated settings for daily and weekly are always being modified.
Reggie, about on the chat, I gave my email address,
Oh,
qqqinvestor@gmail.com. If you send me an email and say, do you have a summary of the current best settings for the strategy, I'll send it to you. We've got a spreadsheet, and it shows that based on the information we have now, If you want to trade SOXL on a weekly or daily basis or TQQ, I'll tell you what those settings are. Just drop me an email.
Or
And we have a few other. I think I don't remember which ones we have. I think we have FNGU and TCL. I'm almost positive we don't have nail. And I don't have FAS, but we have more than just TQQ and SOXL. We probably have FNGU and maybe TECL.
Floyd, those settings can get updated every couple of weeks because of new discoveries. It's like,
Yeah, or maybe
Once a month.
I'll send the latest version with the understanding that as we get more input or more testing, that might change. If I share this sheet with you, it will show that you can successfully trade SOXL. The goal is, I hope everyone understands, Reggie's done such a good job. What we're trying to accomplish here is rather than doing a buy and hold, he showed you how SOXL lost 85% in 1 year. So what we're trying to accomplish here is to capture 2/3 or 80% of an uptrend, not all of it. And then when we start a new downtrend, to not suffer too much of a down on the maximum value of our account and go to cash and get out and not ride this all the way down and wait until we get the next buy signal. And the back testing says that if you do that carefully, it's really easy looking backwards. It's relatively easy to turn $10,000 into $1, $2, $3, $4 million in 11 years. When the COVID crisis hit, you go to cash. And then you wait for that signal and you get back in, you ride that next wave up. We hope that by looking backwards, and it will help make us better traders under future market conditions. Nobody knows what those future market conditions will be. I think we're being smart by assessing what happened in the last few years with an instrument like SOXL and how to trade it. If we get 2 or 3 crazy years in a row, that may cause us to modify our PD and trailing stop values. We have to be careful here. Like Reggie said at the beginning, everything we're doing is for educational purposes. We don't have licenses to tell you when to buy and sell. We're just giving educational training here today.
And just to add to that, JMC, you made a very good point. I will make it a point next time in August to put a summary slide of the most updated settings at the end of my presentation. So I will make sure I add that in there going forward, because that's something I didn't think about. I'll have them in the presentation, but I'll also make sure I add them to the end of the whole presentation so viewers can take that home with them. What do you think, Floyd? I think that would be very useful. Thank you for putting that question in the chat. I think it's very important. I'll make sure I do that going forward.
Yeah. And Gary is the keeper of the spreadsheet that shows the strategy for each TQQ and SOXL. So Gary can give you the latest version of that spreadsheet 3 or 4 days before your August presentation.
Sometimes Gary's latest updates from our cooperative team members like you guys, the latest update shows up 2 days before the presentation, and I can rush to put them together. One, because I actually, even if I get a sheet full of really cool, sexy inputs that looks like it takes everything $50 million, $100 million, whatever number it is, I have to go through and back test it myself, because I'm not just going to go running around putting a strategy in until I have to go through a whole series of back tests for 11 years and through the really tough times to see if it works for me or not. And then I can present the whole thing to you with the good and the bad. And that way, you guys, based on your own personalities and your own style, can decide whether or not you want to incorporate it. Sometimes I'm able to do that if Gary gets into me in time, and sometimes I can't. In this case, I wasn't able to because it came out a bit too late for me to modify this presentation. But I'll make it a point to introduce him next time with a summary slide and everything.
And JMC, if you've got results of your back testing on UPRO, UDown, and LABU, would you please share those with us? So you can email it to me at tqqinvestor@gmail.com. We're most interested in what kind of results you've come up with on your back testing too.
Yeah, you can either email it to Floyd and CC me on that omg.investors@gmail, or just send them to Floyd. Either way, we'll definitely go through them.
If you come up with a killer set of variables that make money, we'll give you 100% credit. I was blown away by nail today. FNGU drops 11, 12%, and nails up like 18% today. What the heck is that about? And I was up today like 10 or 11%. There was a real bifurcation in the market. Some things were soaring like nail and TNA, and then you have other things that are dropping like a rock. I think people are getting excited and assuming that interest rates are going to drop in September, and that may be why nail took off like a rock. If interest rates drop, that's really good for housing stocks.
Just to summarize, folks, in the previous slides, I wanted to show you that drawdowns and losses are two different things. Drawdown in the trade is not necessarily a loss. The portfolio might have significant drawdown, but still have a small loss or even a gain. Sometimes you can have more drawdowns and losses. For you guys as investors and traders, using TradingView program or using whatever other program you use, when you start seeing drawdowns, make sure you know how your system is calculating drawdowns. And that means, in my case, I had to go trade by trade, year over year, to see, okay, this is what I started, say, 2016 with, and then did I lose money from when I started? So for me, that matters because maybe I can handle my account going from 10,000 to 30,000, coming down to 20. And I was like, okay, I could have made 30, but I only made 20. If my account goes from 10 to 20 to 5, the loss affects me a lot more psychologically, whereas for some of you, the drawdown might affect you more. So like I said, each investor to his own, know yourself and your style. If there are any other questions on this slide, or can I go forward? Go ahead. Once.
I have a comment, and that is when we look at numbers, it is one thing, but when your portfolio has gone up quite a bit, even a drawdown of 20% from a high number is.
Everybody's got a different style and level of tolerance. You have to decide what works for you. Even the best strategy is useless if you decide not to apply it. If you're too nervous, if you're scared, then like Floyd says, if you can't sleep at night and you're too stressed out, then you're just better off selling and getting out of the market, but you can get some better sleep. The last part of this presentation is going to be about dollar cost averaging, specifically when it comes to SOXL. DCA. Dollar cost averaging involves investing the same amount of money in a target security at regular intervals over a certain period of time, regardless of the price. Benefits to things like dollar cost averaging can lower your average amount you spend. It reinforces the practice of investing regularly to build wealth over time. It's automatic and it removes the question of timing because you're in the market and ready to buy when prices go up. It takes the emotion out of investing and prevents you from potentially damaging your portfolio's return. Now, dollar cost averaging, when applied to a leverage ETF like SOXL, we're going to get to see how it does. In this case, I only focus on 2017 to 2023, which is a 7-year period. We have 3 sections here. We have buy and hold on the left. We have Floyd's original primary SOXL weekly inputs. And we have the dollar cost averaging. It's a very simple one. We started in January 1st, 2017, $10,000 at the end of every month. Not the first month, but the end of every month after that, we add in $1,000 and keep buying regardless of the price. Here we have the 7 years of performance, and we'll go through that quickly. In 2018, you started in January 2017, and by December of 2018, your buy and hold strategy was down 39%. The weekly strategy using Floyd's original inputs was also down about 36%. If you look at the dollar cost average, your account value is about $30,000. Your total investment was about $22,000. In reality, you have about $7,000 left in your account. A drawdown of over 40% that year. So you've invested for 2 years, and the total gain is $7,100, and that does not include the original $10,000. You're actually down after 2 full years of investing and putting in the additional 23 grand in here. Let's move on and see what happens. Now look at 2021. By the end of 2021, Floyd's strategy has earned 77.45%. Their total account value is $251,000. DC has recovered nicely. Your account value is $531,000, of which $59,000 is your monthly investment. $472,000 is your total gain at the end of 2021. It is very significant compared to $472,000 compared to $251,000 compared to the $183,000 for the buy. This is at the end of December 2021. Now, what happens at the end of where does our dollar cost averaging account stand? The account value at the end of 2021 was $531,000. That has dropped down to $83,000, which is over 80%. So if you look at the total gain, the far right column is at $12,533. If you invested 10 grand in 2017, after 6 years of dollar cost averaging, you have total gain, you have total account value of total gain rather of 12,550. So it's not that great. But fortunately, in 2023, the strong market has recovered and DCA has made back some of its money for a total gain of $209,000. So what I wanted to show you here was dollar cost averaging when applied to leverage ETFs requires a lot more attention. The investor has to be prepared for poor account returns over multiple years. For example, if you started as SOXL in January 2017, you would have been down 9% after 2 years by December 2018. If you started in January of 2018, you would have been down 27% after 5 years by the end of 2022. If you started in January 2021, you would have been down 62% after 2 years of regularly investing every month. This is something that I think Yogesh or somebody else had mentioned in a previous presentation about leverage ETFs. We have not had a severe prolonged downturn like we did 2000 or 2007, 2009. All these ETFs, TQQQ and SOXL, started around March 2010. So we have no idea what a sharp and prolonged downturn like that could do to the LETF price action, how severe the drawdowns would be. So as you saw, a normal bear market, a slow and steady bear market like 2022, the dollar cost averaging method lost about 80%. So for those of you who want to apply dollar cost averaging to leverage ETFs, you have to have some rigorous rules to protect yourself from severe downturn. Dollar cost averaging is long-term. What's long-term? It's 5 years long-term, 7 years long-term. Your kids are going to school. You want to buy a new loan. You got repairs on your old home, and all of a sudden the portfolio value is dropping. These are things to always think about. Set some rules in addition to just averaging, especially for SOXL or leverage ETF. It's not the same as Apple or Amazon in terms of volatility, in my opinion. So please come up with some rules to protect yourselves from that. Do we have any questions at this point about dollar cost average? No? So what have we learned so far? This gentleman is not stressed out. He's 21 and he feels great. Trading is not stressful. Some useful wisdom for you guys from better investors and traders. Investing should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. The most contrarian thing of all is not to oppose the crowd, but to think for yourself. Mark Minervini said, you have to earn the right to trade large positions. This goes back to what Floyd says every time, anybody, is that if your position is so large that you're stressed out, you can't sleep at night, you can't focus on anything else, you're trading too quick. Maybe it's best for your health, your sanity, to reduce the size of the position. All right, folks, that is the end of the presentation. All slides will be available for download in a few days. A video recording will also be available. If you have any comments, suggestions, questions, feedback, anything you want me to cover next time, constructive criticism is always welcome. I will do my best to improve going forward. The next presentation is for August 8th. I will try to include a lot of new things that I wasn't able to get ready for this presentation. I will try to put in a best performing slide at the end based on what data I have. And if there's anything else you guys want to hear, feel free to email me at omg.investors@gmail.com. I will be available and pretty responsible. I'm going to turn this presentation over to anybody else who has questions, comments, suggestions. Please, this is open for everybody to hop in and say whatever they want to say. Please, no silence. Somebody say something.
Good job, Rege.
Thank you, guys. Again, please, guys, when I ask you at the end of it, suggestions, questions, feedback, it's important because that will help me improve and share with you what you want to see in more detail. It might not be the sexiest thing looking at all these tables and numbers because everybody wants to find a new coolest trick. But for those of you who are interested in the details of what really happens over an 11-year period, I put those things together. If you want to see other things that you want me to cover, please let me know. Put that in email to me at the bottom there at my Gmail. I will definitely try to put it together for you guys for the next presentation in August.
We have approximately 700 members in the Anchorage IBD Meetup group. And when Rege sends me the link to the meeting recording and the link to his slides, those links will go to all 700 members. If you're not a member of the IBD group and you want those links, send me an email at tqqinvestor@gmail.com. And we probably will have the recording and the slides no later than Saturday.
Thank you. Are there any other questions? I'm going to stop this recording now.